Good morning. I'd like to call the Oklahoma City Post-Employment Benefit Trust meeting for November 13th, 2023 to order. First item is to approve the minutes of the August 14th, 23 meeting. Got a motion and a second. Record your vote, please. And the motion passes. Item 3 is 3A is elect a vice chair to preside at trust meetings and perform trustee duties in the absence of the chair trustee. I'd like to consider any nominations.
I would like to nominate Laura Johnson.
All right, Laura Johnson's been nominated. Have a second. We got a second. Record your vote, please. That'll teach her not to come to the meeting. So that passes. Item 3B is receive the quarterly investment report, and Mr. Anderson hasn't been able to make it on time. Thank you for doing that. So Doug Anderson.
Thank you, Mr. Chairman. I'll go through the report briefly, but please do interrupt if you have any questions. Let's see, how do I, where's the, I'm looking for the full screen button. Where is it? Oh, well, we'll just go with, well, there we are. Thank you very much. No, that's not what I wanted. Okay, I think I've got it now. On this slide, you can see performance of major market environments for the quarter on the top. This is the third quarter. The information cutoff on this report is September 30th. And below that for the trailing 1 year ended September 30. And you can see it was a pretty rough quarter. Inflation was starting to worry a lot of folks out there. And there was exactly one asset category that was positive, and that is 3-month T-bills. Risk was punished, duration was punished, although credit risk was not necessarily punished as badly as some other risks. You can see the S&P was down 3.3, small cap stocks down even further than that, international equities down in aggregate 3.8%, developed down worse than emerging, and fixed income, again, another very, very difficult period for fixed income. That quarterly return is about as bad as a 1-year return looks for fixed income most of the time in modern history, but it does look like we're going to have 3 years, quite likely, of negative fixed income returns in consecutive years. Highly, highly unusual. But that is what happens when inflation spikes like it did last year. Luckily, as of today, inflation is just below 3%. However, the Federal Reserve traditionally wants that at 2%. So slowing efforts will be continuing in the economy despite what you're hearing from the news on a daily basis. If you look at the trailing 1-year returns though, however, results are strong, especially for equities and especially for the S&P 500, which I'll talk about in just a moment. The winning trade of the year so far is large cap technology, very, very big companies. In fact, they're calling the largest 7 technology companies the Magnificent Seven, and they have driven most of the return this year. And you see international equities also positive, but definitely the U.S. economy is led by the biggest of the technology companies. You can see for the trailing year, bond market results are mixed. One thing I point out with this one is the aggregate 0.6%, trailing T-bills by 4% over the year. If you go back a year and a half ago when the Federal Reserve started raising interest rates because inflation started, interest rates, the Fed funds rate was at effectively 0. Now it's 5 1/3. And that does cause some impacts and some ripples throughout the economy. Looking at the results here for the last year, they're pretty rough. U.S. government bonds down 0.7, TIPS up 1.2, mortgage backs down 0.2%. And a lot of folks are saying that's a very attractive place to be now, looking forward. And then corporate bonds at 3.6. What's not shown on here are high yield bonds, which have done tremendously well in this environment, oddly enough. So low risk assets, bonds, underperforming. The highest risk segment of that low risk category is the one that's done the best. Looking for, let's see, I do want to point out on this slide, on the upper left-hand side, this is the Russell 1000. This is a cap-weighted index. The bigger the companies are, the higher up the list they are. You can see that Apple and Microsoft make up just over 12% of the index. That's really high. If you go down the rest of that list, you can see Amazon, NVIDIA, Alphabet, Tesla, and Meta. We've had some name changes there recently. Alphabet is Google, Meta is Facebook. But NVIDIA is new in the top 10. NVIDIA makes computer chips that are used predominantly in artificial intelligence. It's been a very popular place to be invested this year, and you look at their one-year return for NVIDIA, it's up 256% over the last year. And that is part of the S&P 500 index that is a big part of the equity portfolio. I'm going to go on to fixed income just to spend a few moments here. So I'm not accused of talking only about the positive in the markets and the portfolio. You can see, again, interest rates went higher this quarter because inflation started to worry the markets even more. You can see how that affected performance. And then on the one-year return, one-year performance below that, you can see the U.S. high yield index at 10.3% rate of return. We do have an allocation to that asset category. However, in this environment, I thought it would perform worse than this, but I'm glad that we do have it. And then the yield curve. Yield curve shows you what interest rates are for various maturities of treasury bonds. On the lower right-hand side, you can see that it is inverted, meaning that longer-term bonds currently have lower yields than higher yield bonds. This is unusual. It usually either predicts or causes a recession. The jury's out on that. But a 1 year or a 1 month T-bill had a yield of 5.5%. A 30-year Treasury had a yield of about it's about 4.75 right now. So that's unusual. Usually the longer you lend somebody money, the higher interest rate you charge them, but that's not the case right now. And on the upper chart, just quickly, that gray set of boxes there, Federal Reserve doesn't set interest rates precisely. They set them in a range. Remember, about a year and a half ago, we started at 0, and now it's all the way up to 5.33 to 5.5. And that is the rise in interest rates that you have seen there. Performance for the total fund, 16.2%. Again, this is as of September 30, looking back 1 year, and that return is very strong. You can see that during the quarter, however, the results are negative, and you saw a decline in market value. Distributions, or the beginning market value going back all the way to 2009 was $6 million. Contributions have been 150 million, 152. Distributions, 105. Gains, this is market appreciation, $40 million, ending market value of 92 million. And you can see that the income produced since inception is $12.2 million. So it's double the amount that was first contributed to the fund. And the return over that period of time is 158%. Going to show the asset allocation. We all remember going back to 2008, 2009, just how tough of a period that was. And you can see that we had a larger allocation to lower risk assets at that time. And then gradually, as we went into 2010, 11, we did reallocate more to equities. I would say that 2008, 2009 period really felt like existential risk, like the markets might stop functioning altogether. And I think that risk was a very difficult place to be, especially in the early years of a investment program like this. That's the asset allocation. Market value at the end of the quarter was $92.3 million. And here are the individual funds. These are all liquid. These are all mutual funds. These all have very specific roles that they play in the plan that we have. And if you see the market value change for the quarter, it was depreciation. All but one of the portfolios had a negative return during the quarter. It was a risk-off period in the markets. Looking for the total return. So this is the performance of the total fund rolled up at the very top. You can see the market value, again, $92.3 million. The quarter was rough. We were down 3%. The year to date, this is calendar year to date, was up 7.81%. And those numbers in parentheses to the right is your peer universe. You can see for the trailing 1 year that 16.2% outperformed the policy index, the actuarial index, and it ranked in the first percentile of the peer universe. You outperformed everybody effectively for that period of time. 3 years annualized at 6.06, 5 years at 5.5, and 7 years at 7.47. As we go down that 1 year column, you can see that fixed income was not what helped us, but we have less fixed income than most other funds out there. You can see that the Loomis Sales Fund was okay at 3.5%, but you see very wide variation of returns. Double Line at 1.08. Both of those are about 7.5% of the portfolio, and this is why we diversify. You can see the Lord Abbett High Yield had a nice year, 7.5%, but they were more cautious than most of their peers. And then the Hoisington portfolio at 5%. This is all U.S. Treasuries. Remember when I said Treasuries were one of the worst places to be in the market? They're expecting a recession, and they have long-term Treasury bonds, so that hurt them during the quarter. We've seen this pattern with them before where they underperform, and they usually are in the lowest percentile or the highest percentile versus their peers. You can see Fidelity, again, this is the one that is cap weighted, and it is holding the Magnificent Seven for the 1 year rate of return at 21%, dead on the benchmark. The mid-cap index has also done well versus its benchmark. And then Hotchkiss and Wiley, I don't know if anybody recalls just how poorly they were returning about 3 years ago versus their peers. But since that time, their stock selection has been fantastic, yielding a 1 year rate of return of 28% and a 3 year annualized rate of return of 30%. That is a substantial rate of return. That's doubling your money in 3 years, more than doubling your money in 3 years. And then when we go to the next slide, the small cap growth portfolio and then the international, above median for the year on both of those, but you can see Causeway. Again, we've held this in very difficult periods before, but right now over the trailing year, they're up 42%. They don't change the portfolio that much. It's just value became recognized in the marketplace. They own energy. Energy was the other part of the investment world that did well over the past year. So not going to go over too many of these next slides, but I do want to revisit the status summary. Keep Hoisington on alert. Again, they will prosper once interest rates start to fall. They think it could happen any day. In fact, since this report was issued, treasuries are down some as far as yields go. Prices are up. So hard to say. Forecasting recessions, I don't know if you know this, but usually recessions are usually declared about a year after they happen. And last year we had 2 quarters that were negative GDP growth, which usually qualifies as a recession, but for some reason it did not at that time. But you are seeing signs of slowing in the economy. Here are fees. You can see that the average weighted fee or expense ratio on all the funds invested in is 44 basis points there at the bottom. The weighted average is 91, so you are more than 50% off average list rate for your funds without sacrificing quality for any of those. And then the dashboard you can see here, and our allocation index is 50% S&P, 10% EFA, and 59% S&P, and then 31% aggregate. We have 69% equities. That's more than most of their funds out there. And in a year like last year, where equities did well on balance and fixed income did not, that was a big part of that first percentile ranking that was produced by this fund. So happy to take any questions.
Any questions for Doug?
Yes, I do have a question, Doug. During the last meeting, I had requested, and I don't know if you sent it, and I just didn't see it, but requested our investments, what we are invested in, and the percentages.
As far as individual holdings?
Yes.
I think I did send something, but it's been quite a while. Are you looking for individual sectors? That's a popular question these days.
Well, actually, I'd like to see all of the sectors.
Okay. Yes, I can definitely turn that around.
Okay, thank you.
Something that we are seeing in our world right now and in Oklahoma is there's some, it's odd to see this, but there are some efforts at the state legislature on the statewide funds to encourage them to invest in some areas and to divest from some firms out there. I've been involved in a lot of those meetings, and thankfully we don't have to do any of that here. We don't have any of the managers that are on the list here, and our custodian is Bank of Oklahoma, which is also approved, or not disapproved, I think is the way to say that. So I'll turn that around to you as soon as possible.
And thank you for letting me know that, because that was another one of my questions. It's whether or not we were on that the state list.
Well, we're seeing some things. To me, that is taking choice away from the statewide funds. It's not going down to Tulsa County, Oklahoma City, or anything like that. That's not to say it won't happen sometime in the future. And there's a lot of back and forth on this right now. Interpretation is not clear. It's complicated. But the next thing that we're seeing also is the legislature is encouraging the statewide funds to also invest 5% of their principal in funds or investments in the state. But again, they don't have jurisdiction over this fund. So, but it is something that is emerging. And it could be positive for some folks out there. But in my mind, as a fiduciary, if you were to do that, they would have to compare favorably with every other investment out there, because we're fiduciaries for you, not for investors based in the state of Oklahoma. Hopefully, that encourages them to bring their game up to world-class levels, which I think is possible, though.
All right. Do we formally receive these? We need to formally receive these, so I'll consider a motion on item 3B, and then we'll do 3C as well. Motion is second. Record your votes. Item 3B passes unanimously. Now, item 3C, receive the monthly investment report.
I'm going to go to the October one, if that's okay.
That's
with everyone.
fine.
October was also a tough month. On the upper right-hand side here, you see the downturn in the returns of the Russell 1000 and 2000. On the table in the middle here, you can see that starting with July, 3.44% for the Russell 1000. And then we had 3 negative months in a row. Year to date, calendar year to date, that index is still up 10.28, but small caps, Russell 2000 down, equity, ex-US is international equity, barely positive, and those other two indexes are also down, the bond indexes. And you can see not a lot worked during the month. If you have a month where the only or the strongest performer of all sectors is utilities, it's a pretty tough time for you. That's the most defensive sector out there. And we look over the year to date, and you can see what I mentioned earlier. Not a lot of sectors are doing great. Communications services and information technology, positive. And then you see consumer staples is also positive. That's a very defensive part of the marketplace too. You can even see energy is slightly positive at 0.07% for the 1000. But it's been a tug of war, the third quarter and the early part of the fourth quarter. You can see market value down to 89, which I don't like that. We were just very close to 100 for a few quarters there. And you can see the year-to-date performance, 4.36, 1 year 5.96. And what's dragging this down? Fixed income is negative. Domestic equity is positive. International equity is positive. And again, this one thing I like to point out distinctions and say good job for sticking with these investments that weren't working for a while. International equity, like the last decade or so, over the trailing 1 year, it's your best performer by far. It's almost tripling the return of the S&P 500 index, and it's doing far better than that for the other domestic equity investments. So that concludes the 1031 monthly update.
All right, any questions for Doug?
Well, I do have another question. Sorry. I don't think I asked any questions during the last meeting, so I'm catching up. Do we ever periodically, and I don't know if I'm asking this correctly, do we periodically get a report showing of the companies that we're invested in, excuse me, the percentage holdings of the owners or officers? Do we ever get?
Oh, you're getting really deep on that one.
Yeah.
That's a good one. So that information is freely available. I'm thinking that there's something on the order of, we've got 500, I'm saying there's probably 1,000 stocks overall in the portfolio. So insider ownership, smaller companies, it tends to be higher, right? Bigger companies, they're just so massive. I can look into that for you. Can you clarify?
Nope.
No?
No, probably can't clarify, but I would be interested in seeing, the percentage ownership. As much information as we can get. I know historically with some other funds, there have been, insider trading, insider dealing, and I just want to see the percentage holdings.
Sure. So insider trading has a legal connotation.
Yes, it does.
Not a good one either.
it doesn't.
However, it is an indicator of confidence of people who know more about the company than others. I'm talking about the legal kind, where the officers and employees can't invest in that. And so it's used by some folks out there to be an indicator of things going better than the market expects. Share buybacks by the company itself is also a pretty big deal. And I think that probably happens more often and in larger size than insider buying. But let me start to break down that list. And for me, this is just me speaking, so the index fund, the biggest investment, it's all passive. The mid-cap index, it's the same, it's all passive. So nobody is trading based on that. So maybe what if I start out with the 2 actively managed domestic equity funds and the international equity?
That would be a good start.
Okay, thank you.
Thank you.
All right, any other questions?
I think I'm done.
Are you? All right, you ask more if you'd like.
I'm
All right, well then I'll entertain a motion to receive the report. And it passes unanimously. Thank you, Doug.
Thank you, Mr. Chairman.
Safe travels. Item 3D is to receive the calendar 2024 meeting schedule. We do want to note that the November 24 meeting has been pushed back 1 week due to Veterans Day, and it will be at 9 a.m. in November of 2024. And so I'd like to entertain a motion on receiving this schedule. Motion is second. Record your vote. And it passes unanimously. Now, to item 3E, we're going to receive our actuarial evaluations. John Mallows and Sandy DeKalb are here from Nyhart. So, John, take it away.
Okay, thank you, Mr. Chairman. All right, get started. All right, I'll get started on the overall results. You can see that on the right-hand side is the current results. And the position of the plan has improved over the last year, which is good news. It went from 22% funded on the city side to 26, and COPPA went from 52 to 59.5. You can see that it's a combination of the liabilities falling, and there was some rebounding of the assets from last year, so the assets increased. So that contributed to the improved funded position. Okay, and here I'll go through how we got to the new liabilities on this page. So the liability started last year at 383 million, and then you add service costs, which is the cost of members accruing, active members accruing another year, getting another year closer to retirement, so that there's a cost to that. So that's about 8.8 million. And then there's interest on the liabilities, like a mortgage interest, so there's 19 million in interest.
John,
And then-
can I ask you a
go
quick
ahead.
question? What do you think causes it from the service costs going from $15.7 million in 2022 to be cut in half in 2023? Because if you look at, if you go across the board there, they're around, it's significantly declined.
I'll have to look into that a little bit more. I think part of it might be the interest rate. Yeah, I'll have to get back to you on that one. Yeah, that is interesting. So continuing on here, there's benefit payments that get released once they're paid out of the 15 million. That releases the liability. So the things that vary from year to year is the change of assumptions and the actual expected experience. Now the assumptions, we had a 20 million gain, and that is primarily due to the higher bond rates. So we use a higher discount rate this year because interest rates are higher. So that lowers the liability. So that is 20 million. And the other difference that expected to actual experience is another 20 million, and that is mainly due to the claims costs coming in lower than expected. And so we had a good experience in the claims side. Not sure if that's going to continue into the future, because I wanted to bring up in 2025, due to the Inflation Reduction Act, there's a possibility the Medicare Advantage market might be impacted. We're not sure at this point what the impact would be, but possibility Medicare Advantage premiums could go up more than expected. But we haven't reflected that in this report because we don't have all the details on that yet, but I just wanted to make you aware. Now we go down to the assets. You can see that investment returns have rebounded, almost recuperating the losses from the previous year, adding 11 billion to the fund. And so I went from 84 to 93.7. I also want to mention this is a snapshot as of June 30th. So these amounts won't quite match the previous presentation because that was more recent. So I'll go to the next. Going to COTPA, similar story on a smaller scale. Good experience on the claim side, so that was a big gain there. So that's basically the reason, or small gains, or a big gain on the experience side, but then small gain due to assumptions. Yeah, and then so the overall liability stayed about the same, actually, in the end. And then funded a position to increase a little bit due to assets increasing. Yeah, so the overall funded position is 59.5, which is a pretty good improvement over the previous year. Okay, I'm gonna move on. This is just showing the city's contributions compared to the actual recommended contribution. Now, this is just sort of an illustration. This is what we recommend you contribute, but that you don't have to. So the city has a policy of contributing a little less, which is fine. But this just shows historically the contribution. And the same story with COTPA, contributing just slightly less than the recommended contribution this year. And then I'll go into the OPEB expense, and this is the same service costs and interest costs as we showed the previous page. And then to offset the expense, you have expected asset earnings and assets, and then you also have these amounts down here, which is amortized gains and losses over the prior years. So if you have a gain or loss, it doesn't hit the OPEB expense all in 1 year. It gets amortized over several years. So overall, the OPEB expense is still negative. It's gone from 34 up to 47 million. Okay. COPPA, similar story here. Is the OPEB expenses decreased a little bit though. In the end, it's gone down from 86 down to 18. And these pages just show kind of the background, the historical gains and losses that are scheduled to flow into future OPEB expenses. So you still got a lot of gains to phase in here. And similar to FCOPA. This page here just shows the sensitivity results. You see if the 1% change in discount rate increases the liability about 58 million, and decrease in interest, lower it down about, what's that, 46 million. And similar story on the trend assumptions that we set. 1% decrease in trend can decrease liabilities 50 million, and an increase can increase it about 56 million. So it just shows this kind of sensitivity of the results to our assumptions. And COPPA, a similar story, about 200,000 difference due to interest rates. It's less sensitive to trend because there's more fixed benefits, so they're kind of immune to trend changes. And this just shows the asset breakdown. I'm not going to spend much time on this. All right, and here's the actual contribution. This is how we develop our recommended contribution, but this is just really illustration because the city's not following the recommendation, which is okay. But this is just showing if you wanted to start following our recommendation, this is what we would recommend you contribute, which is a little bit higher than current values. And then this is just our projected for next year. We're projecting liabilities to continue to fall if all our assumptions are realized. And so if everything goes to plan, you should continue to improve the funded position of the plan. And this is COPPA, same story. And this graph just shows the projected payments. Now, this is a closed group because people hired after January 1st, 2017 aren't eligible. So it's a closed group. But payments are increasing just because we're adding new retirees. But it'll level off and start decreasing out in the future. And there's a similar graph for COPPA. And at this point, I'll turn it over to Sandy to discuss the assumptions.
Great. Thank you, John. And I just wanted to go back very quickly to the question from before on the decreasing service cost. I was able to look into it as John was presenting his slides. And I have some sort of an answer. We'll still look into it a little bit more, but since this is a closed group, that service cost will decrease over time as the active population that's eligible for city benefits decreases over time. Additionally, and one page I'll move to here, is the scatter of actives by age and service. You can see that most of your actives, you have none that are in this 1 to 5 years of service, but most of them are actually already eligible. So as they become eligible, that service cost amount decreases. The eligibility is either 10 or 20 years, so you'll see that most of your actives are on the other side of that eligibility. That's one piece of it. We'll double back and we'll make sure that there's nothing else going on there, but
So we could probably expect that to continue to decline?
yes.
Okay.
Exactly. You could expect your service cost to decrease and the active liability to decrease in the future. It might not be as immediate as the service cost, but just wanted to give you some sort of an answer there. We will double back and make sure that there's nothing else there that we wanted to point out on that question.
I do have a question, Mr. Chair. I know you're gonna check into that, and I really do appreciate that, but looking just from a one-year period, I mean, when you look from the previous year, it was about 15 million, and it's now 8 million. Is that an indication of the number of retirees that we had in that 1 year, between that 1 year period, for such a dramatic decrease?
So retirees actually do not have service cost. It is only a function for active employees. One thing that we did see in the data this year was that we saw more termination and more retirements that did not elect coverage. So
Okay.
that did also play into this service cost decrease. It's a little bit of multiple parts, but it was a large decrease, so we want to just, we'll go back and we'll kind of double check to make sure that we understand all the components to it.
I'm looking forward to getting the.
I am too.
It's-
So am
it's-
I.
It's making me go, you know, it's one of those zones.
Especially the number of people not electing coverage.
Right.
Yeah. Exactly. So I'll just briefly go over the assumptions. All of the valuation is built off of projected benefit payments in the future. And for those projected benefit payments, we do have to make assumptions to do our calculations. The first big assumption that is really meaningful in terms of the liability is this discount rate. And this year, we were able to increase the discount rate from 5.38%, to 5.38% from 5.04. So that did lead to a decrease in liability. The discount rate works in reverse of the liability, meaning the higher the discount rate, lower the liability. And the reason that we were able to increase the discount rate was because of the bond rates. They did increase slightly from the prior year. And also the plan was better funded, meaning that we could use more of the 7.5 when blending out the discount rate with the bond rate.
So Sandy, if as interest rates start to decline, as we're all hoping, this could have the inverse effect too, then our funded ratio may go from 26.2, but down to 20% as a, after you
Yep.
do all the, I know it's more than one calculation here.
Yep.
There's multiple variables impacted here.
Yes, and there is a lot going on. We do blend your long-term expected rate of return on your trust, which is 7.5%, with the bond rates. So specifically, if the bond rates were to decrease in the future, that would drive the discount rate down. But the long-term expected rate of return of 7.5%, that might not react as much to the inflation. We'll have to see how that plays out. In fact, that might even go in the reverse of inflation. So lots of moving pieces. If there are major changes, we'll make sure to give you a heads up just so you're aware of what could happen. But you're absolutely correct in that it could change your funded status drastically. That's probably, the discount rate is probably the most important assumption we use when coming up with your funded status. So just as, that's usually why we start here and we have a whole page dedicated to it. I'm going to jump to our assumptions section now, which has all of the details on every single assumption we use. I won't spend a lot of time on each assumption just because some of them are not as meaningful to the results. So we did already discuss the discount rate and the long-term rate of return, which were the pretty meaningful assumptions. We then jump to the healthcare coverage election rate, where we assume a percentage of the active employees are going to elect coverage in the future. Looking at the data, this does seem to hold up, but one overarching comment I'll mention about all the assumptions is that we would recommend periodically doing an experience study where we would take 5 years of your census data, look at the retirement trends, look at the healthcare election trends, and see if it really lines up to the assumptions that we're using. That's done on a 3 to 5 year period, and I don't think we've done one for you guys in the past 5 years, so just something to keep in mind that these assumptions do seem reasonable based off of the 1 year census update, but we can do a deeper dive to make sure they're reasonable in the future. We assume that 70% of male employees and 35% of female elect spouse coverage at retirement. And we have an age assumption of 3 years, husbands older than their wives. We use a mortality table prescribed by the Society of Actuaries, and we project that out with a mortality improvement scale. This is consistent with a lot of our other clients. We generally use the Society of Actuaries mortality table just because they do regularly study and update that each year. And then we use termination and retirement rates consistent with the Oklahoma City Employee Retirement System, or the pension system, essentially. Just because we're talking about the same benefit, we're talking about a pension benefit and a retirement OPEB benefit, so essentially it's the same person, which is why we do tend to be consistent there with the assumptions that we use. All that being said, it would still probably make sense to take a look specifically at the OPEB population, because we do know that there's a cutoff date pre-2017, and maybe it would make sense to see, does this population operate differently than the pension assumptions would suggest? These are very reasonable assumptions because we do know that the pension plan does their own experience study, so it's a good base, but since they are slightly different populations, we do still recommend an experience study every once in a while. And here we have the details on the retirement rates. And then the last assumption I'll really mention here is the healthcare trend assumption, and this is probably, I'll say, the very second assumption when it comes to importance on our valuation. It's right up there with the discount rate, where it really is meaningful in the liability and projections that we do. And it's essentially the inflation rate on medical premiums and healthcare costs. So it's different than the inflation rate that you'd see for everything else. It's specific to medical amounts. And we do use a select and ultimate table, meaning that we start assuming that medical inflation will be 7.5% for pre-65 premiums and 6.5% for post-65 premiums. Those amounts trend down over time until we reach a 4.5%, which is what we assume that long-term premium rate increase will be in the future. We study this assumption every single year, and we use national surveys, state-specific surveys, actual premium experience just to develop a standard assumption. And we use a standard assumption for most of our clients, unless for some reason that there is a reason not to. For you guys, we are using that standard assumption, and we do find it to be reasonable. But as John mentioned, the possible change to the Medicare Advantage plans could lead to changes in the future, specifically on that post-65 piece. We do have some details here on the difference between the explicit subsidy and the implicit subsidy. Essentially, the explicit subsidy is what the city actually pays out in cash for the benefit, and the implicit subsidy is a GASB requirement that we have to value based off of the premium rates offered, meaning that retirees are offered the same premiums as actives. So essentially, the retirees are getting a subsidized premium, and GASB does require us to calculate that subsidy and value it as a liability. It's not a cash benefit. It's not a cash that's coming out of the city's benefit. It's more of a nebulous number, and in some cases called a paper number. It's just a number that you need to report, but it's not the same as your explicit subsidy, where we're going to pay this premium for our retirees. That does cover all of the comments I had on assumptions, and I believe all of our prepared remarks. Any questions on anything that we've gone over?
Any questions for Sandy?
Okay, great, thank you.
All right, thank you, Sandy. All right, so I would consider a motion to receive the actuarial evaluation. I have a motion and a second. Record your vote. Passes unanimously. Thank you both for coming today. Item 3F, ratifying and approving the issuance of a RFP for the stop loss insurance. Jason Long's here to answer any questions, or do you have any comments, Jason? This is a routine item, so I would entertain a motion. Passes unanimously. Item 3G is ratifying Addendum 1, adopting joint resolution. This is related to a contract with United Healthcare for a Medicare Advantage Part C benefit plan for eligible retirees and eligible retirees of participating city trusts, subject to annual appropriation for January 1, 23 through December 31, 2024. Is that a typo there on effective January 1, 2023? Should that be 2024? Okay. So is that okay to make note of that, Counselor?
Can I move it with the correction?
Yes. We got a motion with the correction. How would you like to do that?
Let's vote on an amendment.
Okay. Okay. So we would like to have an amendment to item 3G to amend the date from January 1, 2023 to January 1, 2024. Got a motion and a second. Please record your votes for the amendments. Count me as voting yes. Please.
Mine is still waiting.
Yeah.
Vote aye.
Aye.
And it passes, the amendment passes unanimously. Now we will consider item 3G, ratifying this with the amended date of January 1, 2024 through December 31, 2024. We have a motion and a second. Please record your votes. Item passes unanimously. Then item 3H, again, is a joint resolution with the Oklahoma City MFA and renewing a modified administrative services agreement with Blue Cross and Blue Shield of Oklahoma to provide dental care insurance for eligible employees and retirees. And this is effective January 1, 24 to December 31, 24. I'll entertain a motion. Record your votes. This item passes unanimously. Now we're on to item 3I, is to ratify the claims from August 2nd, 2023 to October 31st, 2023. Motion and second. Record your votes. Item passes unanimously. Now we're down to item 4, comments from trustees, staff, and interested parties.
I have none.
No comments? All right. Then we're on to item number 5. Now that we're at the end of this, we are adjourned at 10:47.